Okay, so let's proceed with our regular agenda. Can I, and there weren't many, but can I have a motion to accept the in-camera motions, please, to ratify them?
I so move.
Can I have a second?
I can second.
Colleen? Any discussion? Hearing none, the question, all in favor?
Aye.
Opposed? Abstentions? Motion carries. Okay, is there any changes that we have with regards to the order of business? And any other additions or deletions, Heidi? Or are we good?
I didn't hear any from anyone unless anybody has some.
Okay, hearing none, we're going to move on. So the approval of the minutes of the regular meeting on Thursday, March 26th. I'm assuming everybody's had a chance to review. Can I have a motion?
My apologies. We actually need somebody to move and second the approval of the order.
Okay.
Business.
Thank you, Lorna. You're right.
Okay, can I have a motion for approval of the order, please?
So
Moved.
move.
I move.
I'll second.
Okay,
Thank you.
all in favor? Abstentions or objections? None? Okay. So now move on to the approval of the minutes of the regular meeting held on Thursday, March 26th, 2020. Can I have a motion for acceptance, please?
I so move.
Moved by Colleen,
I'll
seconded by Ted. Any discussion, errors, or omissions that anybody saw? No? All right. Then we'll call for the question. All in favor of acceptance of the minutes, please? All right, objections, abstentions, motion carried. Okay, so any business arising for the minutes? I didn't see any. Did anybody else?
Mr. Chair, I'm just going to jump in here for a second just to note for everyone that, yeah, I'm sure people have been seeing other Halifax Water staff pop in and off their screen. And that's just, this is a virtual representation of what you would have seen typically in the room of people filing in.
That's fair enough. That's fair enough. No business arising? Okay, we'll move on. So let's get on with the meat of the business. Which is item 4.1, 2019-20 audited financial statements of year-end results. And I'm assuming that we're having a presentation from our auditor. So Louis, do you want to lead us on this?
Yes, Kathy, before the meeting said I have 2 hours, so I hope to have a wholesome conversation.
Kathy
I think Kathy she lied. I don't have 2 hours. Heidi, I don't know if you have the presentation. So as Heidi sets up the presentation, it's a quick run through of the report that we did to Audit and Finance. At the Audit and Finance meeting, we did have our auditors here who led them through sort of their comments. All the information that went to our Audit and Finance Committee is in front of you as well. So if there are any questions related to what the auditors presented, we're happy to walk through that as well. So the presentation that's here, if I can go to the next slide. There are a couple parts. I plan to run through sort of the balance sheet side, a quick run through the income statement side, a couple of the highlights on the new notes that we've added for this fiscal year, and then a little bit of our transition between IFRS, which is the format that you're looking at here, to the Utility and Review Board statements, which we're required to submit as well. So we'll have a little bit of a transition and a short conversation about the two different types of reporting. So the first slide we have here relates to our current assets. As you can see, cash receivables from our customers and from HRM, inventory prepaid, a total of about $92 million. Cash went down about 1.7 million. There are considerable details as to what caused that change in the statement of cash flow. The second part that we have is, or a significant item, is an increase in receivable from HRM. Most of that relates to cost sharing that is outstanding through some of our cost sharing programs. On the long term or the non-current assets, this is where the big numbers are in terms of our assets. We have intangible assets, which are primarily studies that we conduct as a utility. It also includes any easements that we have. So that category increased by about $3.5 million. The other more significant ones are our utility plant and service. So those are our assets, a total of about 1.2 million. We see an increase there of approximately 47 million. So we increased our assets close to 94 million. We had amortization of about 44. The net amount is the increase you're seeing there. On the current liability side, as you'd expect, payables and accruals are a significant piece of our business. The increase in payables primarily related to our capital projects. So at the end of the year, the invoices and or the accruals related to those assets has driven up our payables. The current portion of long-term debt and the current portion of deferred contribution, we'll talk a little bit more as we go into this section. On the long-term liability side, so here's where our deferred contributed capital. So under IFRS, any of the assets that are donated to Halifax Water, including the transfer of assets related to wastewater, stormwater, are recorded in the deferred contributed capital and are amortized over the life of the asset. So that's a significant number on our liabilities. We also have our long-term debt. So we increased debt by approximately $36 million year over year. And our repayments were in the neighborhood of 25. So you see that increase. You will also see the employee benefit obligation. So that's related to any of our Halifax Water pension plan and any of our post-retirement and pre-retirement benefits. There's quite a fairly detailed note on that, but our liability decreased by approximately $9 million. So the next slide is just a snapshot of our comprehensive earnings. I'll talk a little bit more about that in the next couple of slides. So on the operating revenue side, we had revenue as a utility of 138 million. We've broken it up here a little different than the information you see in the financial statements to give you a sense of where the revenue is coming from. So our consumption revenue, about 86 million, down slightly related to a relatively small decrease in consumption of 0.22%. We did have an increase in the base charges. The number of accounts increased by about 619. The other item I wanted to highlight was on the stormwater site generation. You can see the revenue going down. Most of that is related to an adjustment we were required to make around the stormwater revenue that we had billed to the customer. So we're required to make an adjustment, and you can see that adjustment here. On the operating expenditures, this is the expenditures by service. So you can see where we spend our money, approximately $139 million in expenditures, an increase year over year of 6.2 billion, primarily related to wages, increase in some of our cost groupings. You can see also had an increase in our pension expense based on our actuarial valuation, and of course depreciation. As our assets go up, our depreciation also increases. Well, I just wanted to reference there is a note to the financial statements that presents the same information, but in the different categories. So it highlights it by salaries, etc., as opposed to by service. So the next slide is around our financial and other revenue and our financial and other expenses. The major issues here are around the amortization of the contributed capital. So under IFRS, we're required to amortize our contributed capital over the life of the asset. So you see that cost here, approximately 19 million. And then the other sort of big cost under the expenditure side, is the dividend or the grant in lieu of taxes that we pay to HRM, approximately $5 million. The next slide relates to our other revenue. So we have the significant item here is the other comprehensive earnings. These are adjustments that are made to our financial statements, primarily related to the change in our accrued benefit obligations. So that's the significant revenue that's reported here. As I said, I wanted to just highlight a couple of the key notes. We do note disclosed under our subsequent events that we have approval to generate new debt, approximately 27 million. That debt requirement has already come to the board. The board's approved it, and we're in the final stages of a paperwork part of this with the Municipal Finance Corporation, and we anticipate receiving our payment, our cash, very early in July. We also note disclose the dividend agreement with HRM. So that agreement was brought to the board earlier. So the details are provided to the readers of the financial statements. We do have the essence of 3-year agreement with HRM, and that's note disclosed in our commitments note. The one that's new this year or previous years relates to COVID-19 and highlights for the readers some of the changes that were made to assist with our customers. So right now, we do not anticipate that these changes will have a significant impact on the organization, but we do want to note for the users, and that again is in our subsequent event. As I mentioned earlier, we do have 2 sets of books in the private sector. That's usually not a good thing. In our case, we have IFRS financial statements. We also report under the UARB accounting handbook. What you see in essentially the differences between the two. So under IFRS, we have comprehensive earnings of almost 21 million. Under UARB, we have a deficit of about 1.6 million. So the major difference there, primarily trying to transfer our financial statements under IFRS to under UARB more of a cash basis financial statements. So you can see that we take away, add back or subtract non-cash items. So you see the pension expense, which is not expense, not cash, being added back, and you see our debt principal being recorded as an expense. So you see our surplus being decreased by the $18.7 million there. The other item is the other comprehensive income, again related to a non-cash item, so that revenue is removed. So those are the 3 sort of significant items that bring us down to the deficit of 1.6. This next slide sort of shows the URB accumulated deficit or the current year deficit of 1.6 by our service areas. So you see the water generated a surplus of about 5.2. Most of that related to the change related to a reduction in the amount of debt payments assigned to the water services area. On the wastewater side, we have a loss of about 5 million. Most of the increase there relates to increased costs around our wages and overtime, but there's also increases related to capital and materials and supplies. On the stormwater side, we had a deficit of 1.7. Again, we talked about earlier about the reduction in revenue related to hard to make. That's reflected in the increase in the deficit. And on that happy note, that's the end of my presentation. If anybody had any questions, we'd be happy to discuss.
So this is Kathy. I just wanted to indicate that We have a clean audit report from Grant Thornton. I want to thank the Halifax Water staff and the Grant Thornton team who worked on this. And this presentation was also given in more detail to the Audit and Finance Committee last week. The Audit and Finance Committee did approve the financial statements, and Grant Thornton were present at that time to also present their audit report to the Audit Committee and had an opportunity to go in camera with the Audit and Finance Committee. So that's the backdrop for this coming to the larger board today.
Thanks, Kathy, and thanks, Louis. Prior to opening any discussion or questions, could I have a motion, please? No.
I can do that.
Can you verbalize the motion for me, Ted?
Yes, absolutely. I'll move that we recommend that the board approve the financial statements of the Halifax Regional Water Commission for the year ended March 31st, 2020.
Second.
Thank you. Any question or discussion, ladies and gentlemen? Lorna, do you see any hands? I don't.
There are no hands in the air.
Oh, awesome. Wonderful. All right, so ready for the question? All in favor?
Aye.
Objections? Abstentions? Motion carried. Fantastic. Louis, you have like what, an hour and 45 minutes or something? You want to go ahead with item 4.2, please? The pension plan.
Yeah, so Alan Campbell, who is the manager of finance at Halifax Water, he'll lead you through that presentation.
Great, thank you.
Thank you.
Good morning, folks. My name is Alan Campbell. I'm the manager of finance here with Halifax Water. I hope you all can see my screen. It looks like you can. Okay, so that's positive. Yeah, I'll just give a rundown of with regards to the pension plan audit that finished December 31st, 2019. A little bit of a background. The valuation, the last valuation we had was January 1st, 2019. And we do evaluation every 3 years, basically. So it was an interesting year for us because with the December 31st year end, it would be interesting to see how the results from the being a year out from the valuation would fare out. The valuation in January of 2019 saw our first planned surplus in 19 years. So it was a very positive thing, and that came about from numerous changes that we made to the pension plan as far as benefits were concerned back in 2015. The other thing worth noting as a result of the valuation as well, where we're in a surplus position, there would be no special payment basically to fund the unfunded liability, and that was about $800,000. So that would be contributions that we have been making into the plan that wouldn't be there this year. So I guess if we just cut to the chase, the financial position at December 31st, 2019, we did end up in a surplus position. We went from a surplus of approximately $2.1 million in December 31st, 2018 to a surplus position of $8.7 million in 2019. This was driven mostly by an increase in the assets available for benefits. The increase we saw there was $1.5 million. The benefit or the pension obligations themselves did increase as well. So they increased by about $8.4 million, $8.5 million from $124 million to $132 million. But where we gained leverage as far as the surplus was concerned was that the assets grew at a faster rate than the pension obligations themselves. This is sort of a depiction of what our pension plan looks like. So if you envision it as being a bucket, in the top of the bucket, we have sort of investments, earnings or inflows, basically, investment earnings that flow into the bucket or our plan. And also we have plan sponsor and plan member contributions, and that would be monthly contributions through our payroll deductions going into the plan. At the bottom, we obviously have payments going out of the plan. So we have benefit payments. These would be benefit payments to pensioners on a monthly basis, as well as any termination payments during the year that we pay to individuals. And to a smaller extent, plan fees and expenses. So we see here, as far as the inflows are concerned, revenue in 2019, $14 million, contributions, $6 million, and outflows of $5 million. So this brings us to the actual change in our plan for the year of $15.1 million. That's an increase of about $8.3 million, $8.4 million over the previous year. We'll take a little bit deeper dive into the actual components here. So as far as revenue is concerned, revenue, as I said before, increased $14 million over the year. The increase in that was made up of two things, basically. The increase in the fair market value of the assets of $10.6 million, and also the investment income that we earned in the plan in the master trust of $3.4 million. Comparative to 2018, the actual revenue was $4.5 million. So we saw an increase there of about $9.5 million altogether. A couple of highlights, excuse me, with regards to our actual investments. So our funds are invested with the HRM Master Trust. We own about 6.3% of that Master Trust. The net fund rate for 2019 in the Master Trust was 10.1%. Comparative to 2018 of 3.8%. So we did fairly well last year in 2019 with respect to the Master Trust. I just want to point out, and we'll probably speak more to it a little bit later in the presentation. Fair market value of assets tend to be more volatile year over year. We did have an exceptional year in 2019 where the fair market value of the assets, as I said, increased by $1.6 million, but comparative to 2018, that increase was only $1.8 million. So you can see the volatility there with regards to the fair market value of the assets. The other inflow into the pension plan, as I said before, was contributions. So we had contributions of $6.4 million in 2019, comparative to $6.2 million in 2018. Contributions make up a large portion of, I'm sorry. As far as the actual valuation was concerned, there was a number of changes in 2019 that sort of came into play in 2019. Current service costs for both employee and employer went up, not materially, but they did go up a little bit from 20.5% to 20.68%. As I mentioned before, as far as reductions in contributions going into the pension plan itself, there was an end to the special payments. So there was that $800,000 basically that wasn't going into the plan. Increases as far as contributions were concerned, we saw net new hires in 2019 of approximately 25 employees. We did have one reciprocal transfer into the plan in 2019, which accounted for an inflow of about $400,000. And as far as actives, at the end of the year, we had actives of 456 employees compared to 431 from the previous year. As far as expenses from the plan, so we've dealt with the inflows, now we're dealing basically with the outflows. So expenses totaled for 2019, $5.4 million. Of that, pensioners and pay, so this is the actual payments that we make on a monthly basis to our pensioners, amounted to $4.2 million. So that You can see there that pensioners and pay account for quite a bit of our expenses that we do on an annual basis, approximately 78% of the total expenditures. Comparative to 2018, expenses were $3.8 million. And also worth noting, in 2019, there was termination payments of about $1 million. The expenses, they increase annually by our annual indexing. So we have sort of two levels of indexing, pre-2016 and post-2015, so 2% and 1% respectively. So we did reach those maximums this year. The actual setting of the indexing is based on CPI from the previous year. So CPI in 2018 came in at 2.1%. So the maximums were reached in both groups with respect to indexing. New retirees in 2019, we had 15 compared to 10 in 2018. Pensioners in pay at the end of the year, we had 151 pensioners in pay. Compared to 145 the previous year, and terminations of 14 compared with 6 the prior year. And that gives the, as far as the terminations in pay were concerned, we went up, as I noted above, we went from $1 million this year in 2019 as opposed to about $100,000 in 2018. So that's what the big swing there was. Pension obligations. So pension obligations increased to $132 million in 2019. They're up from $124 million approximately in 2018. This is made up basically of two things. So the accrued benefits and interest increased by $13.7 million for that 1 year period. And this increase was offset by any retirement and termination benefits that were paid in 2019, and that amounted to $5.2 million. Worth noting, as I said before, we did a full valuation at January 1st, 2019. On January 1st, 2020, which would play into our year end of December 31st, 2019. It was an extrapolation. It wasn't an actual. It wasn't an actual valuation. However, the assumptions and methodologies used for the going concern valuation for January 2019 were used in the extrapolation. In summary, we had a clean audit committee. Excuse me. We had a clean audit opinion. The plan continues to improve, as we saw with respect to the net rates of return for 2019 compared to 2018. Returns of the master trusts are exceptional, but worth noting is the COVID-19 effect, which happened after year-end, but it's worth noting, and it's noted as a subsequent event in our financial statements. The fair market assets, fair market value of the assets went down approximately 2.6% or $3.7 million, and that was as at our latest figures were as at May 31st, 2020. 2020 and beyond. Again, we have the COVID-19 experience that we're going through right now, and where that goes, nobody really knows right at the present time. We did see a little bit of recovery with respect to our investments, but I'm not sure where that's going to go in the future. Again, a full recovery of the economy basically is contingent upon any healthcare solution that's available, and I'm talking probably vaccine there. We're fortunate in the respect that we don't do our own investments in that stuff. All our funds are sort of leveraged through the HRM pension plan and the master trust. So a couple of mitigating factors, I guess, with regards to any risk that we do have with regards to our pension funds is that the HRM pension plan actively manages the pension plan. Also portfolio diversification. Any swings, major swings in any sector would be offset by sort of downturns in any other sector. So there is quite a bit of portfolio diversification there. And also the focus is on the long term. So a lot of people get hung up on the short term, what the markets are doing, that stuff. But again, as far as the pension plan is concerned, you have to look at the long term. You can't focus on the short and medium term. So I think HRM has a good handle on that. There were some legislative changes that came through on April 1st, 2020. And these should have little effect with regards to our funding strategies with respect to the long term. I know that the superintendent of pensions is going more of with respect to defined benefit pension plans, at least, on more funded status for pension plans. And I think we've sort of covered that off in just the way that we manage our discount rate, for example. We have very conservative, we take a very conservative approach. So I think that should have very little effect. Anything that came through as far as legislative changes would have very little effect on a go-forward basis on a going concern. And finally, the next actuarial evaluation will be scheduled in 3 years' time for January 1st, 2022. And I'll take any questions you may have.
Excellent. Thank you, Alan. Always excellent work. Ladies and gentlemen, before any discussion, can I have a motion, please? Anybody?
I can do that. I move
Thank
that
you.
the commission board approve the audited financial statements for the Halifax Regional Water Commission Employees Pension Plan, the plan, for the year ended December 31st, 2019.
Thank you.
Not
Second.
bad for new guy, huh?
That's pretty good.
Yeah.
Seconded by Ted? Yes, Ted?
Yes.
Saw your
Yes,
hand
yes,
up?
yes.
Okay, thank you. Any questions or discussions for Alan, please?
So I don't have any questions for Alan, but I want to remind the board that the Halifax Water Board are the trustees of the Halifax Water Employees Pension Plan. So that's why this is here. As part of your duties as a trustee, you have to receive and approve the financial statements. After you approve them, we do have to file them along with some annual information returns with the Superintendent of Pensions of Nova Scotia and also with the CRA.
Mr. Chair, there are no hands in the air.
There are no hands in the air. Okay. Well, one comment before we go, I said it at Finance and Audit, I think it bears repeating, is that, we have hit this road bump in COVID-19. And yeah, that has affected the fair market value. But Halifax Water's pension plan is very well positioned because of the excellent work that the Halifax Water team has done prior to this. If it wasn't for the work that was done over the last couple of years, this would be a pretty dire situation. And instead, I think it's being managed very well. No, we can't predict the future, but I think the pension plan's in excellent hands. So thank you for that, for Alan and your team and Louis and Kathy. It's been fantastic, and I think the employees are in good hands. So call for the question. All in favor?
Aye.
Aye, I'm here.
Any objections? And there he is.
And if I may,
All right. Sure.
Craig,
Go ahead.
can I just pass on my thank yous to my staff as well. It's been a real learning curve for me, and we've had some new players. And then on top of that, trying to do the audit virtually, it's been kind of a new experience for all of us. And I think it worked out well, and I just want to pass on my thank yous to them.
Thank you very much.
Thank you.
All right, I believe we had approval on that motion, so we can move on. And there's nothing under capital approvals. Last item of business on our agenda is the corporate balance scorecard. Kathy, you're up.
Thank you. Heidi's got a few slides she's going to throw up here just to guide us through the discussion. But the corporate balance scorecard has been in place at Halifax Water since 1999. And the report we're bringing you today is to give you the year-end results, to tell you how we've done against that scorecard, And also, we have a motion in the board report to revise a couple of the organizational indicators that were set for the 2021 fiscal year. We brought you a report in March to set the indicators for this year. And at that board meeting, you had encouraged us to go back and consider what impact COVID-19 might have. We did that, and we concluded that, yes, we should in fact adjust a couple of the indicators. So Heidi, if you could move maybe 2 slides in. Great. So the corporate balance scorecard is designed to align with the mission and vision of Halifax Water. And I won't bother reading the mission and vision. You've seen it a number of times this year in both our 5-year business plan and our annual business plan. If we could move 1 more slide. We have critical success factors that align directly with supporting or moving the organization forward in achieving the strategic vision. So high quality drinking water, service excellence, responsible financial management, effective asset management, workplace safety and security, regulatory compliance, environmental stewardship, and motivated and satisfied employees. And if we move to the next one, you'll see that we're going to jump right into the results. So we've got the 1920 target. The column in blue is the 1920 result, and then we've got the 2021 target that you have approved at the March board meeting. So with respect to the high quality drinking water, you'll be pleased to know it's all good news. All of the targets were achieved this year. And probably the most complex target here is the adherence with the 5 objectives of the Water Quality Master Plan. That's the top one, where the score was an 82 this year. And the Water Quality Drinking Master Plan, excuse me, the Drinking Water Quality Master Plan is appended to our 5-year business plan if you want to look at it in more detail. But basically, there are 5 objectives that get equally weighted in assessing this target. So there's disinfection, chlorine residual, there's disinfection byproducts, particle removal, and corrosion control that are all a part of ensuring we make sure the drinking water quality meets its objectives. Bacteriological tests, we scored as close to 100 as you can get. Technically, it should round up to 100. Customer satisfaction, this is based on our external customer survey done by Narrative Research this year. The customer satisfaction about water quality was 87%, which is a very high result. Next page. Service excellence, we also have 4 targets in this area. The customer satisfaction, again, comes from the external survey conducted by Narrative Research. The result this year was 96%. We are generally pretty consistently high on the customer satisfaction survey. It's interesting to note that for the first time this year, we did include some questions around stormwater, and we know that there were stormwater-only customers included in the survey. That makes this result that much more special for us this year. The next 2 targets are around service reliability, essentially, the hours of water service outages and the hours of wastewater service outages. And you'll see that the results both achieved the target, and wastewater in particular had a fabulous result. The only target we didn't achieve in service excellence relates to a customer care center metric, which was average speed of answer at the call center. So our target this year was the percentage of calls answered within 20 seconds. We set a target of 60 to 65%. Unfortunately, we only achieved 32% this year. There were a number of things going on there. The 3 major drivers of the failure to achieve this organizational target was the fact that we were in the final year of the AMI project. So we had a higher volume of calls, and we're escalating a lot of calls in order to get those final AMI meter installs done. Also, our third-party meter installer partner had a few call center outages at their call center. So when their call center was down, that diverted more calls to our call center. So the higher volume of calls we received as a result of AMI, coupled with understaffing, which at some points of the year was as much as 40%, meant that we didn't achieve our target around average speed of answer. But you'll be pleased to know we're meeting that target right now, and we are on track to succeed in that area this year. Move to the next slide. On the responsible financial management target, the most important indicator on this one is the operating expense to revenue ratio percentage. And when this corporate balance scorecard program was initiated, there's an organizational award tied to it that is meant to keep all employees focused on moving the organization forward and achieving the organizational indicators and the critical success factors. And the program is self-funding. So if we are successful in hitting our operating expense to revenue ratio target, then the organizational award program is funded. If we are not successful, then it is not funded. And there's also another gateway indicator that we'll talk about later on that's tied to safety. The only organizational indicator we didn't hit on the financial side was the average cost per customer connection for wastewater. You'll see there in the 1920 result, it's $718 per customer connection. Our target was $708. That's one area where we need to do a little bit more digging in to see what happened. But I have a suspicion that the tropical storm last September and Hurricane Dorian probably had a factor in that. Next slide. Effective asset management, we have a number of targets in this area, and the most important one, or one that's been around the longest too, I would say, is the water leakage control. And you'll see that we set a target for a leakage allowance of 160 liters per service connection a day. Actually, the 1920 target was a range of 160 to 170. That's a more aggressive target than has existed in previous years. And we didn't achieve that target this year, you'll see, because we were at 176. And this is a target where we're going to be doing some more work this year. And Reed Campbell will be leading some folks within his department to take a look at what is the economic level of leakage we can realistically expect to achieve, because there's a point of diminishing returns after which, you know, we'll have to invest more money to get at chasing a leak than the benefit we would actually receive from having that leak addressed. So that is one target that when we come back to next year with new targets, we'll probably be looking for revisions. The next one is I&I reduction. And this is one of the areas where we were successful in achieving the target for this year. We did 1,086 private property inspections this year, but we know that this is a target that's going to be impacted for 2021, and it's going to be difficult for us to achieve. So we're proposing that the target for 2021 be reduced to 450. That's why there's an asterisk in that column. The next target, peak flow reduction, we've got a note down the bottom of this slide, not note 2, and it's in the board report, just explaining that we didn't have any actual results to report just because the projects that was tied to did not proceed. There were some delays in getting Nova Scotia Utility and Review Board approval. The next target, which is very important, is the percentage of time GIS and city works are available. So our crews and our engineering department and operational folks depend so heavily on these systems being available that we have set a target of 95 to 97% that those systems should be running. And the result for this year was fabulous, as they were in service 99.88% of the time, so very little outage hours. The next target, capital budget expenditures, or the percentage of budget spent by the end of the fiscal year, is a target that the board added to the corporate balance scorecard, I would estimate, probably 2 years ago. And it's a really important target to the board and to us because it's meant to drive some efficiency in how we're spending our capital money. And the target set for this year was 80 to 90% of the capital budget approved this year being spent within the year. And at the time of printing of the board report, we didn't have the final number available. We do now, and it's 69% of this year's capital budget that was spent within the year. And we do have a good breakdown of the projects that didn't get spent, why it didn't occur. And there's a few major explanations: securing necessary land approvals and securing Nova Scotia Utility and Review Board approvals are two of the bigger issues. And the third, I think, would be projects that we have that are tied to HRM projects. And if the HRM initiative gets delayed, then our projects are delayed until they happen. Next slide. Workplace safety and security. I'm not going to say a lot about the targets in details, other than to say that the results of the safety organizational indicators were excellent. All of the targets were achieved, even the new one. So this year we had a new target, the average score on internal safety audits. And you'll see the target was set at 85 to 95%, and the actual result was 89%. So hats off to our staff who have all really moved the safety culture forward in the last year or two. The other important target on this slide is the other gateway indicator, lost time accidents. So a few years ago, in order to really focus on safety, we added a second gateway indicator, which is lost time accidents. So our target is 2 to 3 per year. Our actual result this year is 1.6. So if we don't achieve the gateway indicators, there is no organizational award program. Next slide. Coming in on the home stretch, we've only got a couple left. Regulatory compliance. This is an interesting one. The percentage of public health and environmental regulatory infractions, when you look at the 1920 result, you might think that things went off the rails, but Halifax Water's activities have not changed, nor has our level of compliance. What has changed a little bit is the processes and the reporting with Nova Scotia Environment that they're using to manage permits and corrective actions. So this is one where in future years, we may have to either adjust our target or adjust the measurement of our achievement. So we're going to take a wait and see approach for this year, and then we'll decide if we need to do anything with that target in future. The next one is the percentage of wastewater treatment facilities complying with NSE approval permits. And this target was not achieved this year. You'll see we're at 91.2%, and the target was 95 to 100%. The reason that this one was not achieved was due to some unexpected failures in one of the process trains at the Dartmouth wastewater treatment facility. But we are on track this year to achieve that target, hopefully, barring any other unforeseen events. Next slide. Environmental stewardship, our performance in this area was good. We did achieve our ICI inspections this year that we wanted to do, but this is an area where we do recommend adjusting the target for 2021. You'll see that our initial target we'd set in March was 500. We're proposing that we be reduced to 440. The reason why we're proposing that is very similar to the other target we wanted to revise. Any activities we're doing that requires us to get into people's houses or get onto private property to do inspections, it's a little bit more difficult for us to do that now in light of COVID-19. The other two environmental stewardship targets were both handily achieved, the energy management target and the biosolids residual handling. Next slide. Finally, our last one, last but not least, because this is important to us, motivated and satisfied employees. So you can see on this slide that our number of arbitrations divided by the total number of grievances is one of the indicators. We did have 2 arbitrations this year and 27 grievances. That's not unusual because it's the year following execution of new collective agreements. And whenever you have new collective agreements, then you always have some language that's not perfect, and you'll have some differences in interpretation that basically have to get sorted out through the grievance process. The percentage of jobs filled with internal candidates, I'm disappointed to say, is only 65%. And when I look back at the history, this target has never been achieved. So one of the things we want to take a look at this year is how we are approaching this target. We think that it's laudable to have a target to have a high number of jobs filled with internal candidates. We're concerned maybe we're not measuring it correctly, because all of the entry-level jobs have to be excluded, the jobs where you have no choice but to hire somebody from the outside. So we're going to make sure that we're measuring that correctly. The other thing we're doing is we're rolling out a talent management brochure and some additional career planning tools that hopefully will help employees prepare themselves for the jobs of the future. The employee satisfaction survey result, we had a B+ this year. That's an improvement from the B that we had last year. We still haven't hit the target. The 1920 target was an A-, and if you look at the 2021 target on this page, that should actually be an A- also. But we are hopeful that with continued effort around employee satisfaction, that we'll be able to achieve that. And finally, the average number of days of absenteeism, we're quite proud of the result there, 7.54. That's pretty good for a public sector organization, comparable with some private sector, particularly as there might have been a little bit of COVID-19 related fear, stress hitting the last month of the year. We are concerned that COVID-19 may impact absenteeism in 2021, but we're going to leave the target where it is and hope to achieve it. So I don't know if there's any more slides. Just this one that really shows that the total maximum score we can achieve is a 12. This year we achieved a 9.62. So we're quite pleased with that result. And if we move to the next slide, we're going to continue using the scorecard. It drives our performance forward. Once the board approves adjustment of the targets, we'll begin to communicate with employees and roll out new posters and new information to keep them motivated to achieve the 2021 results. Thank you.
Okay, thanks, Kathy. Prior to any discussion, ladies and gentlemen, can I have a motion, please?
I can make that motion.
Thanks, Colleen. Can you verbalize it for me, please?
I so move that the Halifax Water Board approve the revised corporate balanced scorecard targets for 2020-2021 for inflow and infiltration reduction and institutional, commercial, and industrial property inspection.
A second.
Mr. Chair, this is Heidi. I'll just jump in here for a moment just to recommend that the motion be somewhat refined to indicate that it be approved in accordance with the recommendation in the report.
Thank you very much.
Like Heidi said.
What Heidi said. Can you capture that, Lorna, what Heidi said? Ted, are you okay with that?
Yeah.
As the second.
Yes. Is Heidi okay with that? Yeah, okay.
Okay, great. Any discussion or questions for Kathy?
Colleen has the question.
I just had two questions. The capital expenditure, we often struggle year over year. I know we're focused on that. Any thought that should also be revised, or you're happy to keep it as a target, knowing that some of the HRM projects may also be deferred?
So I'm going to turn that over to Jamie. We do know that some HRM projects have been deferred, and we do know that achievement of 80% this year is probably unlikely.
Yeah, thank you, Kathy. I would tend to agree there's some uncertainty within some of our programs, specifically related to a couple specific projects where we're trying to positively integrate with the municipality. I know there's some technical and logistic timing to optimize when the Cogswell project goes out to market, and it doesn't look like there'll be a large expenditure on that project this year, and not necessarily COVID related, just related to the practicality of when the municipality can appropriately deliver that project. But there are a few other projects where COVID may be challenging us on some of those integrated projects. But I must say that Halifax Water and the municipality are making solid advances on their capital programs for this year, and there's a lot of capital. If anybody's been driving around the peninsula in the last couple of weeks, you'll see the evidence of that. However, I do think there'll be a bit of a mitigative approach based on the COVID fiscal constraint.
And similar question on the customer satisfaction. You addressed it with your comment on the current call center status, but do you think there's any impact there, either between remote work or increased calls with the rate case and bill deferral? Are you happy with the 70% on the call response time?
I see Louis pop on. I think he wants to answer this one.
Just before or as the COVID-19 was hitting us, we implemented a new telephony system. So it was originally scheduled, I think, to be rolled out in June. I think we did it in a week, just as COVID-19 was hitting hard. What we've seen is our call volumes are down from where they normally are, primarily, I think, related to not some of our collection activities being reduced. But we're currently hitting a target of about 95 or 96% of calls answered within the 20 seconds. Our abandonment rates are significantly lower, and our attendance and our number of employees that are available for work has increased drastically. So our results so far have been very, very good.
Okay, thank you.
Any other hands up there, Lorna?
Nope.
Oh, Ted.
Actually, you're muted, Ted.
I don't seem to have the hand button, so I have to raise mine. I had one or two questions, and I just want to say that the good report, and it looks like overall the company did very well at meeting their objectives, and I was happy to see that. And I will always point out the thing that pops out to me is lost time accidents and safety in general. I was really pleased to see that the result was a 1.6. The target was between 2 and 3. So that's a good job by the employees here. Thank you very much. I wanted to ask for a point of clarification on regulatory compliance. We say our target is 0 to 2. The result is it's broken up into SOTs and warnings and directives, and I needed some help understanding what the difference is between those and how serious those things are.
And here to answer that question is Kendra McKenzie.
Morning, everybody. That is a good question, and it was a bit of change for us as well. What we've realized through our relationship with Nova Scotia Environment, historically, if they found something during an audit, they have regular audits, they have to come and visit the different facilities. And if there's a document that they didn't see when they needed it, they would send us an email and we would present it, and then the issue would be resolved. They're formalizing more of their approach to dealing with these types of issues. And so they may issue an inspection report with a warning attached to it, or an inspection report with a directive. And it's simply for us to provide information by a set time. And we appreciate that because it does provide the formality and the transparency to what we're doing. So in the past, where we wouldn't have received necessarily a directive to provide a document by a date, they are now doing that. So as Kathy indicated, we want to kind of see how this year goes with responding to directives and requests for information to see if we need to adjust potentially the language even in the corporate balance scorecard metric on 0 infractions. So it's unfortunate that it may look like we had something wrong when we didn't. So the intention of that directive was always if we had a major catastrophe and failed to react or failed to do something or were negligent and were issued a ticket per se. So we may have to look at adjusting the language.
Thank you. So in that case, did we actually hit the target? Do the warnings and directives count towards the target of 0 to 2? Or are those below? They don't count.
So it's one of those things that I think we need to have possibly a discussion or look at the fact that the intention was the issuance of a ticket per se, that we would be fined or charged. We were not fined or charged. So I feel that we did hit the target, but we, because of the way the metric was written, wanted to be forthright and upfront with what did we receive this year. And so that's why it's illustrated that way.
Yeah, if I may, in answer to your question, Ted, in terms of the way that target has been set historically, yes, I would say they did hit the target as it was intended. The difference I think now is that administrative protocols have changed. Department of Environment, which means we may have to rewrite the target because we now have more formal early warning signs as opposed to what we had before, which was quite informal. So in terms of the way that we could previously objectively measure the target, they met it. But I would say we have more objective information than we previously had, so we may have to adjust.
Thank you both. Makes sense. I think that's it for now.
All right.
Commissioner Hensby has the question, Mr. Chair.
Just to follow up on that question with directives versus warnings. A warning is more like a shot across the bow saying we have something to look at and react to. But a directive, is that more like a ministerial order? And can they only give tickets after the directive has not been satisfied? Just curious of, from a directive to a ticket, where your time lapse or not?
Yeah, so typically a warning is given to say that we saw something that was missing or something that's needed. The directive provides a timeline for when they want to see a report by us or a study by us or follow-up completed. And then if there's no action taken by us, or the action, if we aren't taking the correct action, that's when you would start to see us getting into a fine or a ticketing process, depending on the severity of the issue.
Thank you.
Any other questions or comments, ladies and gentlemen? Lorna, do you have anything?
There are no hands in the air, Mr. Chair.
All right, then we'll call for the question. All in favor?
Aye.
Aye.
Any objections? Abstentions? Hearing none, motion carried. Unless there is anything else, can I call for a motion for adjournment, please?
Mr.
Motion to
Chair.
adjourn.
Kathy doesn't want to leave yet.
No, no issue with you adjourning. I just wanted to note, to get it on the public record, that there are some information reports in your package that we have to file with the Nova Scotia Utility and Review Board by June 30th. That would be the 1920 cost containment report. And we're pleased to report that since we've introduced that program, our cost containment total is $6.9 million. We also have to file our annual lead service line program report with the Nova Scotia Utility Review Board. So there's a report there in your package and on the public agenda that gives a good overview of what we've achieved this year. And finally, there are two other information reports that are new. One is the impact of COVID-19 on our operations, which you may be interested in. And the final one is an update on corporate social responsibility and diversity initiatives at Halifax Water. Thank you.
Thank you, and I would encourage all members to have a look. I dove into the COVID report last night, and one comment that I will make is, again, Kathy, to you, to your team, fantastic job managing through very, very difficult circumstances. It has, at Halifax Water, once again, from my perspective, has been exemplary and fantastic job in very, very difficult circumstances. Unless there is anything else.
I believe Commissioner Hensby has one last
Yes,
question.
Commissioner Hensby.
Yeah, just with Kathy's notices there in regards to them being filed with the Utility Review Board, once they're filed and documented, do they become a public document, and will we have a press release or an information release out on that, especially about the lead line replacement progress? I think that's one of those good news stories out there that we should be promoting.
They are public documents now, and if the board would like us to do some kind of press release around filing of the lead service line report and the progress we've been making, we'd be happy to do that.
I think it would be great to have some good news stories once in a while.
Absolutely. Absolutely. I would agree. Anything else, ladies and gentlemen? David, are you still happy with your motion to adjourn? Awesome.
You bet.
Thanks very much, folks. Do appreciate it. Have a great week.